Welcome to our Forex education videos. In this next video, we're going to give you an example of long-term trading. Now, there are three parts to this video. First and most important, there are a few aspects that we need to take into consideration when we're looking to place long-term trades. One very important factor is the size of your contract. That ultimately plays a very, very strong part when you're trading long-term. The price movement, fundamental reports, support and resistance level using charts of 12 hours, daily, and monthly charts. We're going to give you a few ideas on how to put a long-term trading strategy together. Now, this is going to be something that you will learn to perfect over the course of time and adjust it to the way you feel comfortable. First and most important, we want you to take a look at this chart here we have in front of you. Here we have about 4 years of price movement from June of 2006 all the way to April 13th of 2012. Now you can see there's been a lot of movement over the last couple of years, on the upside, on the downside, and we've been here in a range ultimately to 133.07. Whenever we focus on a chart or the price movement, for example this chart, this gives us a lot of information that is not relevant to what's happening right now currently in the price movement. When we go back to 2008, approximately here, the price of the euro was 160.44, and the price moved lower to approximately 123.25. Now there was a reason for that. There was a reason why the euro was consistently moving higher, and then all of a sudden it dropped lower, and this was during the financial crisis with Lehman Brothers, and all the banks here in the US got into economic problems. Soon after, the price started moving higher, after we didn't have a collapse here in the US. But you can see that the price, once we got up to 151, it dropped once again. Well, there was a reason for that, and that was Greece. And that brought the price all the way down to 118.75. Then you can see the price started moving back up, all the way to 149.50. And once again, the price started coming back down. This was because of Greece, this was because of Ireland, this was because of Spain. And that's the reason why the price moved down to 126.10. And this is where we currently are right now. Approximately 134.05, and we had a little retracement to almost 135 from 126. When we're looking to place long-term trades, you can use a long-term chart such as a daily, weekly, monthly to get reference points, but we don't need reference points such as 160.52 or 119 when we're trading at 133. We're very far away from these points. So we need something a bit closer, and that's the reason why we recommend when you open a chart, you use something that allows you to go back approximately 3 to 6 months. A 3 to 6 month history is more than enough to give you support, resistance levels, and a lot of reference points that you can use for when you're looking to place long-term trades that are going to last you anywhere from a few days to a few weeks, even a month or two. So let's do that. What we're going to do is we're going to change this graph to a daily, and you can see a daily chart brings us all the way back to 2011. The highest level we have here is 149.37. The lowest level is 126.30. Even at this point, a daily chart is a little too much for what I'm looking for. So I'm going to bring it down to a 12-hour chart. A 12-hour chart allows me to go back to November of 2011. Now this gives me a little more of a clearer picture. I want you to notice the difference between a 12-hour chart, daily chart, and a monthly chart. The monthly chart allowed us to go back a couple of years. 12-hour chart only brings us back to a couple of months. As we mentioned, whenever you're looking at long-term trading, yes, you can use a daily chart and a monthly chart. But you should look for something where you're comfortable and you're able to visualize anywhere between 3 months and 6 months worth of price movement. That should be more than enough for you to be able to analyze and get reference points on the price movement. For example, here we have a high level of 142.47. What happened at 142.47 that made the euro come all the way down to 126.25? There had to be a reason why the euro moved lower. And the reason the euro moved lower was because of Greece and Italy. When the price got down to 126, it started moving back up. Now the question is, why did the euro start retracing all the way up to 135 when it was previously at 126. We're talking about almost 900 pips from a consistent downtrend all the way back up to 135. What happened? What is the reason that the euro rebounded so strongly? Well, it's quite simple. After such a huge drop, and Greece being able to receive the bailout money and remained in the euro, that was received as something positive, and therefore the euro started moving higher. And that's all that it was, is just based on good news. So we have to learn how to play the market also when such events take place. By the second quarter of 2012 and the end of 2012, we feel that we should have similar events happen once again, either with Spain or with Italy, even Portugal, where we can see one of these countries in need of money or a bailout, which would drive the euro lower. So the point that we're trying to make is that all these events play a part when we're trading currency. And this is why it's important to keep up with current events. Now we want you to take a look at this chart once again. We're going to cut the time frame from 12 hours to 6 hours. We already know that the price came all the way down from 142 all the way down to 126. But this is the current price that I'm interested in as a support level, 126.20. Now on the high side, after the price moved up to 134.82, almost 135, after Greece received the bailout funds that they were waiting for and remained in the euro, that's what drove the price back up. We already mentioned this before. The price started moving lower, down to 130. And from 130, we had a few fundamental reports that brought the euro back up to 133.88. And currently, we're at 133.35. Now, if I'm looking to place a long-term trade, we don't really know if the price is going to reach 134 or 135 once again. We have reference points on the high side of 134.84. That would be our resistance level. We have a support level of 126, but we also have a support level here of 130.04, which is something closer than 126, which I'm going to use as a reference point. So my two reference points are going to be 135 and 130. And currently the price is 133.41. Let's say 133.50 to make things easier in this example. Now we feel that the euro over the next couple of days should come down in price, and certainly over the next couple of months. The date here is 3/30/2012. It is a Saturday. On Monday, we're going to look to see if the price either moves lower or moves higher. But we still have these two reference points. Now, as we mentioned before, we don't truly know if the price will go to 134 or from this point will start moving lower. Now, our belief is that the euro will continue to drop in price because we have countries like Spain that are preparing to create their own austerity measures to put in place in order to avoid situations such as Greece. But it's not going to be an easy task. And as they run into economic problems, we feel that the market is going to react negatively, as it always does, especially when the media gets involved. And you see something on any financial channel such as Bloomberg, CNBC, right away the markets react. And if it has to do with a country such as Spain needing any funds, we should see the euro come down in price. And that's where we feel we will be able to benefit. Now, we don't really know, as we mentioned before, if the euro will go to 134, 135. We believe that it's going to get back down to 130 over the next couple of days, perhaps a week or two. But we're not sure when it's going to happen or how fast it's going to happen. We have to take it day by day. So we're going to place a trade here at 133.50. And that would be our first sell long-term euro. And because we don't know if the price is going to go higher or lower, we're prepared for the price of the euro to move against us by at least 100 pips. We would be able to get into another position selling the euro at 134.50, 100 pips apart from our first trade. And that would be it. Placing a stop at approximately 136. Now, as you can see, our trades are not 20 or 30 pips apart. One trade would be at 133.50. Our second trade would be at 134.50 with our stops at 136. And we're looking to hit a target of at least 130.00. That is a long-term trade. Now we're going to evaluate this position, but using different contracts. Now this is where you're going to need to pay very close attention.